Welcome to The Deep Dive, your essential shortcut to understanding complex reports like earnings calls. Today, we're taking a deep dive into Snap Inc.'s second quarter 2025 results. These dropped after market close on August 5th. And this was definitely a report that painted a picture, didn't it? Kind of navigating some, short-term hurdles while also making these big, ambitious, long-term bets. So what's the real story hiding behind those headlines?
That's exactly right. Snap's Q2 earnings, they definitely sent some ripples through the market. You saw that immediate, pretty notable shift in investor sentiment as all the details started coming out. It's sort of a classic case, the market digging into every single line item, especially when a company seems to be at this kind of pivotal phase.
Okay, let's kick things off by just laying out the headline numbers because, these are what grabbed everyone's attention first. So Snap reported GAAP EPS of negative $0.16. That was just a penny shy of the consensus estimate, which was negative $0.15. And revenue, that came in at $1.345 billion, also just slightly under the $1.35 billion consensus. But, even with those misses, it still represented a respectable 9% year-over-year jump in revenue.
Right. And while those GAAP EPS and revenue numbers showed that slight slip against what people were expecting, it's really crucial for you listening in to look beyond just those first headlines. Take the user metrics, for instance. They kept showing really robust growth. Daily active users, DAUs, they hit 469 million. That's also up 9% year over year. And monthly active users, MAUs, reached 932 million, climbing 7%. So good user growth. However, the Adjusted EBITDA, which is, basically a measure of their operating profitability, that saw a pretty significant dip, down 25% year over year, coming in at $41 million. And that immediately flagged a concern for investors, didn't it? Because that user growth wasn't quite translating to the bottom line maybe as much as they'd hoped.
Okay, let's unpack that a bit. The slight revenue miss, plus that quite noticeable dip in Adjusted EBITDA, that definitely caught the street's attention. The analysts, the big investors. What was the story management was telling to explain this? Were there specific, maybe unexpected issues, or was it signs of broader trends hitting their top line this quarter?
Absolutely. Management highlighted, several factors that played into that revenue growth. The most prominent one seemed to be an issue with their ad platform. But they also mentioned the timing of Ramadan and something they called de minimis changes, basically really small shifts that still added up. But that ad platform glitch, it was particularly impactful. They said it specifically caused some ad campaigns to clear auctions at substantially reduced prices, which basically means advertisers were getting ads placed for way less than usual. And that meant ad revenue growth just tanked, basically, to about 1% in April.
1% in April. Wow. It's a huge deceleration.
Yeah.
So this wasn't just some general market softness for them. It was a really specific kind of operational hiccup. How fast did they manage to fix that? And what did it do to their different ad types, like, direct response versus brand ads?
Yeah, that's a really critical question. Management said they pretty much recovered in May. They reverted the change that caused the problem. And since they rolled that back in June and July, ad revenues apparently have been growing more in the 3 to 4% range. So it shows they can move fast on technical issues. As for the segments, most of that slowdown hit direct response, or DR, advertising. The ads focused on getting someone to do something right now, like install an app or buy something. It's super sensitive to performance changes. So while total ad revenue grew 4% year over year for the quarter, DR ad revenue was actually up 5% year over year. Brand advertising, on the other hand, the stuff more about awareness, that was flat in Q2. So that DR side, which is often seen as like the engine of digital ad money, it definitely felt the impact of that glitch the most.
Okay, so even with those headwinds and that ad platform mess, management still sounded pretty upbeat about certain growth drivers. They specifically talked up something called sponsored snaps, said they were a meaningful and profound evolution for their ad business. What exactly makes this new ad unit so great in their eyes, especially when overall ad revenue growth was slowing down?
Well, what's really fascinating here is how they describe sponsored snaps. It's a new ad unit, right? And it appears natively, like right inside the chat inbox, which, is one of the places people use Snapchat the most. Management claims this spot drove really significant extra reach and conversions for advertisers. They actually reported some pretty eye-popping numbers, like up to a 22% lift in conversions when sponsored snaps were part of broader campaigns. And even more striking, users who engage with these ads apparently showed 2x higher conversions, 5x higher click-to-convert ratios, and even 2x longer time spent on websites compared to other ad spots. So essentially, it seems like a really high-engagement, high-intent surface that's delivering actual value where their audience is already super active.
Those are genuinely impressive results for a new ad format. You'd think, on paper anyway, the market would be cheering that on. So why the cautious reaction to the overall results then? It really feels like the market is seeing something different than what management is highlighting with these specific wins. There's a disconnect there, isn't there?
Yeah, and this really gets to the heart of the market's caution. It's a great question. The initial rollout of these sponsored snaps, right? While it created more ad supply, more places to show ads, more impressions, it also led to less auction competition initially. Fewer advertisers bidding against each other for those new spots meant lower platform-wide CPMs.
CPMs, cost per mil, right? Cost per 1,000 views.
Exactly. So basically, they flooded the zone with new inventory, which initially outpaced the demand for it, bringing down the average price for advertisers. Now, management's expectation is that as demand builds up for this new, apparently effective inventory, it'll become more and more accretive to revenue growth. It's that classic supply-demand thing playing out with a new format. And the market, well, it seems like it's waiting to see that demand actually catch up before fully buying into the story.
Right. Okay, so beyond advertising, what about other ways they make money? I heard something about subscriptions. That seems like a pretty big shift from just ads, ads, ads. How significant is that diversification effort becoming for them?
Indeed. And this is actually a very bright spot in the report. Snapchat Plus, it's their subscription product. It continues to be a real standout performer for Snap. It's getting close to 16 million subscribers now. That's a huge 42% increase year over year. And maybe even more importantly, it now represents an annualized run rate of nearly $700 million.
Wow, $700 million run rate.
Yeah. So this other revenue category, which is mostly subscriptions, grew an amazing 64% year over year. It's becoming much more meaningful to the overall business. They also introduced Lens Plus, which is a new kind of higher tier subscription. It offers exclusive and AI-powered lenses, and they're leveraging the fact that people use lenses like 8 billion times a day on the platform. So it's a smart move, right? Diversify revenue, monetize that super engaged AR user base, and get a more stable recurring income stream.
Okay, so Snapchat Plus is looking like a surprising but very tangible win. But it still feels like Snap's really long-term vision, the one that gets people excited, still relies on that massive bet on augmented reality. They've been working on this for ages, haven't they? Especially with spectacles.
Oh, absolutely. And perhaps the most audacious play here, the thing that really sets Snap apart maybe, is that long-standing bet on AR. They've invested, get this, over $3 billion in AR over the last 11 years. They're trying to build what they call the world's only full-stack, vertically integrated AR platform.
Full stack meaning they control everything.
Yeah, from the hardware, the glasses themselves, to the software, the operating system, the tools. And they even nurture this huge AR developer community, 400,000 creators who've built over 4 million lenses.
Yeah.
That's massive. And they're consumer-ready AR spectacles. They're slated for public launch in 2026. That's a pretty aggressive timeline, and it could potentially put them ahead of competitors like Meta in the race for real, widely adopted AR glasses. The idea, I think, is that this vertical integration gives them a unique strategic advantage, a moat, in delivering a really smooth, differentiated user experience. And that's key for getting consumers on board with something so new.
That is a bold claim, especially thinking about how much money hardware development costs and the ongoing investment needed. How are they actually funding this massive long-term vision? Are there worries about the cash burn given the current financials we just talked about? Are they really self-sufficient here, or are they going to need more cash down the line?
Well, this is where their financial discipline seems to come in. They actually generated $24 million in free cash flow this quarter, and over the last 12 months, it's about $400 million in free cash flow. They ended the quarter with a pretty healthy $2.9 billion in cash and marketable securities on hand. Plus, they bought back 30 million shares in Q2 for $243 million, which helps offset dilution from stock-based compensation. Management was quite clear on the call. They believe their free cash flow and strong balance sheet give them the financial flexibility they need for these big investments. They also hinted they're open to partnerships for the spectacles launch, which suggests they might explore different ways to fund it too. So for now, it looks like they're largely self-funding a lot of this R&D from their main business and existing cash. That's a pretty powerful position to be in.
Okay. And speaking of costs, were there any other notable trends or shifts in their spending that jumped out during the call, especially with these long-term projects going on?
Yeah, a couple key things on the cost side. Infrastructure costs were up 11% year over year, but that's largely tied to continued investment in machine learning and AI models, which is really a direct investment back into their core product, right? Aimed at making ads perform better and personalizing content for users. So you could call it strategic spending.
Makes sense.
Yeah. But they also show some tighter cost control elsewhere. They kept their full-year guidance for infrastructure costs per DAU in the same range, $0.82 to $0.87. They expect to be in the top half of that range, which shows some efficiency gains. And crucially, they actually lowered their full-year stock-based compensation guidance by $30 million at the midpoint. That really suggests a much more focused, almost laser-targeted approach to hiring and managing resources. They seem to be very deliberate about where the money's going.
Okay, so you've painted this really complex picture for us. Some misses on the top line, especially that ad revenue growth hiccup, but also these pretty significant strategic moves and promising growth spots like sponsored snaps gaining traction and that rapidly growing Snapchat Plus subscription base. How does the market square this divergence, this kind of push and pull between the immediate numbers and that really long-term vision?
Yeah, this divergence, it's not exactly new for Snap, is it? And it's precisely why the market reacted the way it did, with shares dropping about 16% after hours. That immediate reaction really reflects the street's intense focus on that top-line miss and just a general cautious to neutral feeling about the company right now. The buy-side skeptics, the big funds, the institutional investors, they're looking for, quote, proof of sustained revenue acceleration. They want to see these new ad formats do more than just improve conversion rates. They want to see them drive significantly higher overall revenue, consistently. And the sell-side analysts. Firms like Barron's called the results disappointing. Reuters highlighted the slowest revenue growth in 12 months. So there's this clear disconnect, right? Management is framing sponsored snaps as this major inflection point, a turning point for ads. But the market punished the soft ARPU that's average revenue per user.
Right, ARPU.
Yeah, indicating that even though user numbers were growing well, the money they were making per user wasn't quite meeting expectations. It feels like a classic show me situation for a lot of investors. They're kind of tired of promises and just want to see consistent execution now.
That really captures the tension perfectly. Okay, so looking ahead, what are the key things you, our listeners, should be watching for, especially with their guidance for Q3? What are the indicators that might show if these strategic plays are actually starting to pay off and maybe bridge that perception gap with the market?
Good question. For Q3, Snap's guiding for revenue between $1.475 billion and $1.505 billion. DAUs around 476 million, and Adjusted EBITDA between $110 million and $135 million. Now, that revenue guidance pretty much lines up with the 3-4% ad revenue growth they're seeing right now, post-glitch fix. So to really close that valuation gap they have compared to bigger peers, and to kind of reshape their story from, growth at any cost to more of a diversified, cash-generating platform, investors are going to be watching several catalysts very closely. First, obviously, the Q3 earnings report in late October. Will revenue re-accelerate towards that $1.5 billion midpoint? That's key. Second, continued growth in Snapchat plus NAFTA. Getting towards that 20 million subscriber milestone would be a really strong signal that diversification is working. Third, the holiday season rollout of new ad products like First Snap and Smart Campaign Solutions. Can they drive extra demand then? And finally, looking further out, that early 2026 developer preview of their consumer AR specs. That's going to be a massive moment for the long-term story.
These are really the clear checkpoints, the milestones, where the market will be judging their progress.
All right, perfect time then for our This Is Not Financial Advice segment. This is where we pitch an outrageous, maybe, but plausible trade idea based on everything we've just discussed. Just something to get you thinking beyond the immediate quarterly numbers.
Okay, here's one for those out there with a, let's say, high-risk tolerance and a very, very long-term view. How about this? Go long Snap while simultaneously going short Meta.
Ooh, a pairs trade based
purely on the thesis of the AR hardware race. Snap's deep, vertically integrated AR stack. Plus that stated 2026 consumer spectacles launch. It could give them a decisive early lead in what might be the next big computing paradigm, truly human-centered computing. So the trade hinges on Snap's kind of niche-focused approach to building a full AR ecosystem. You're betting that their decade-plus investment will result in better product differentiation and user adoption compared to Meta's, broader, much more capital-intensive, and arguably less focused metaverse strategy. And if that plays out, it could ultimately lead to a major re-rating of Snap's long-term value as the AR market starts to actually take shape. It's definitely an asymmetric bet on the future of personal computing itself.
Interesting. Very interesting. So wrapping this all up, what does this mean for you, our well-informed listener? Snap's Q2 earnings really show a company caught between these significant short-term headwinds, like that ad platform glitch we talked about, and these truly ambitious long-term strategic plays. And while the market reacted pretty cautiously to the immediate financial misses and the somewhat conservative guidance, management did point to some encouraging signs from new ways they're making money, like sponsored snaps, and that continued strong growth from Snapchat plus Slows.
Yeah, ultimately, this deep dive really highlights a company that's investing incredibly heavily in its future, particularly in augmented reality, which, they genuinely seem to see as a fundamental reinvention of computing itself. The big question really for investors, for observers, remains, will these huge long-term bets actually pay off before the current market pressures become too much to handle? And can the demand for these new ad formats truly scale up to match the new supply they're bringing online? That's key.
It certainly gives you something profound to chew on, doesn't it? Is Snap's patient, multi-billion-dollar investment in AR and this aggressive push into new ad tech, is it a strategic masterstroke that's eventually going to drive a massive re-rating for the stock? Or will execution remain the big question mark, the swing factor, in the coming quarters, making this a much longer and maybe riskier journey than some people are hoping for? We will definitely be watching closely. Thanks for joining us for this deep dive into Snap's latest earnings call.